Hey everyone, and welcome back to the channel. Today, we're diving deep into a topic that's absolutely crucial for your financial future. Saving versus investing. A lot of people use these terms interchangeably, but trust me, they are two completely different beasts. Understanding this difference is the first major step toward building real, lasting wealth. So, grab a coffee, get comfortable, and let's break it down. First up, let's talk about saving. What is it, really? Saving is the act of putting money aside in a safe, easily accessible place for short-term goals or emergencies. Think of it as your financial safety net. This is the money you'd use if your car suddenly breaks down, you have an unexpected medical bill, or you're planning a big purchase in the next year or two, like a down payment for a house or a dream vacation. The key words here are safe and accessible. Your savings should be liquid, meaning you can get to it quickly without any hassle. This is why people typically keep their savings in places like a standard savings account at a bank, a high-yield savings account, or maybe a money market account. These accounts are FDIC insured, which means your money is protected up to a certain amount. It's not going anywhere. So, saving is fantastic, right? It's responsible, it's secure, and it's essential. Every single person needs an emergency fund. Financial experts usually recommend having 3 to 6 months' worth of living expenses saved up. This buffer gives you incredible peace of mind. It means a job loss or a surprise expense doesn't become a full-blown financial crisis. You have a cushion to fall back on while you get back on your feet. And this is a huge but, saving alone will not make you wealthy. And here's why. The biggest enemy of your savings is a sneaky little villain called inflation. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, the purchasing power of currency is falling. Let me put that in simple terms. The $10 you have today will buy you less stuff next year, and even less the year after that. Let's look at the numbers. The average annual rate of inflation over the long term is around 2 to 3%. Now, what's the interest rate on your typical savings account? If you're lucky, maybe you're getting 1 or 2%, especially in a high-yield account. Most standard savings accounts offer much less, sometimes as low as 0.01%. Do you see the problem here? If inflation is chugging along at 3% and your money is only growing at 1%, you are effectively losing 2% of your purchasing power every single year. Your money is literally becoming less valuable just by sitting there. It's like trying to run up a down escalator. You're putting in the effort, but you're either standing still or slowly moving backward. This is where our hero, investing, enters the picture. While saving is about preserving your money for the short term, investing is about growing your money for the long term. Investing means you're putting your money to work. You're buying assets that you believe will increase in value over time. These assets could be stocks, which represent ownership in a company, bonds, which are essentially loans to a government or corporation, real estate, or mutual funds and ETFs, which are baskets of many different stocks or bonds. Unlike saving, investing comes with risk. The value of your investments can go up, but they can also go down. There are no guarantees. The stock market is famously volatile. You'll see good years and you'll see bad years. This is why you should never invest your emergency fund or money you'll need in the short term. If the market takes a nosedive right when you need to fix your roof, you could be forced to sell your investments at a loss, and that's a terrible position to be in. So, if investing is risky, why do we do it? Because over the long run, the potential for returns far outweighs the returns you'd get from a savings account. Historically, the stock market has provided an average annual return of around 8 to 10%. Let's compare that to our savings account again. If you have $10,000 in a savings account earning 1%, after 30 years, you'll have about $13,500. Not bad. But if you invest that same $10,000 and get an average annual return of 8%, after 30 years, you'll have over $100,000. That's a life-changing difference. This incredible growth is powered by the magic of compound interest. Albert Einstein supposedly called it the eighth wonder of the world. Compound interest is when you earn returns not just on your initial investment, but also on the accumulated returns from previous years. It's a snowball effect. Your money makes money. And then the money your money made starts making its own money. The longer you let it work, the more powerful it becomes. This is why starting to invest early is one of the most powerful financial moves you can make. Even small, consistent contributions can grow into a massive nest egg over several decades. So, How do you get started? It can feel intimidating, but it doesn't have to be. You don't need to be a Wall Street genius or have a ton of money. You can start with as little as a few dollars. A great entry point for beginners is to invest in low-cost index funds or ETFs, like those that track the S&P. When you buy a share of an S&P 500 index fund, you're essentially buying a tiny piece of the 500 largest companies in the US. This gives you instant diversification, which helps to spread out and manage your risk. Instead of betting on one or two companies to succeed, you're betting on the American economy as a whole to grow over time, which has historically been a very good bet. Many brokerage firms now offer zero-commission trades and have no account minimums, making it more accessible than ever. You can open an account online in minutes. The key is to be consistent. Set up automatic transfers from your checking account to your investment account every month, even if it's just $50 or $100. This strategy is called dollar cost averaging. By investing a fixed amount regularly, you buy more shares when prices are low and fewer shares when prices are high. It takes the emotion out of investing and helps you build a disciplined habit. Let's recap the big picture. Saving and investing are not enemies, they are teammates. They each have a specific and vital role in your financial plan. You need savings for your short-term goals and for that all-important emergency fund. It's your defense. It protects you from life's curveballs. But to build real wealth and beat inflation over the long haul, you absolutely must invest. Investing is your offense. It's how you grow your money and secure a comfortable future. Whether that means retiring early, traveling the world, or leaving a legacy for your family. Don't let your hard-earned money lose its value sitting in a loan trust savings account. Build your safety net first, then put the rest of your money to work. Start small, be consistent, and think long-term. The future you will be incredibly grateful that you did. Thank you so much for watching. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe for more content on personal finance and building wealth. Let me know in the comments below. Are you more of a saver or an investor? Or are you trying to find that perfect balance? I'd love to hear your thoughts. See you in the next video.